There is a rule I spent my whole life repeating in my books, in my lectures at Columbia, year after year, to room after room of young men who thought they already knew how markets worked, to anyone really who would sit still long enough to listen. Never put too much of what you own into a single name. Spread it out. Stay humble. Assume always that you are wrong about something you cannot yet see. I did not say it once. I built an entire life around it. My fund for 30 years held more than 100 different securities at a time, more than 100. That was not caution for its own sake. It was a confession written into the very shape of the portfolio that I did not trust any single one of my own judgments enough to lean the whole house against it. And the one decision that made me more money than everything else I did across 20 years put together was a single company. One bought heavy, bought in a size that broke nearly every line I had just finished writing in my own book. So you tell me, was the rule wrong or was I just lucky? My name is Benjamin Graham. Some people are kind enough to call me the father of value investing. Tonight I am not going to defend that title or polish it or tell you the flattering version. Tonight I want to tell you about the night I betrayed the very thing the title was built on. And I want to tell you the truth about it, which is more complicated and more useful than the legend. By the end of this, you will be able to tell two things apart that look completely identical from the outside. The first is breaking a rule, because you understand precisely what you are doing and why. The second is breaking a rule, and then, when it happens to work, calling your good luck a talent. From the street, those two men look the same. They made the same move. They are wearing the same satisfied expression. But one of them will be alive in 20 years, and one of them will not, and almost nobody can tell which is which while it is happening. Most of the men who blow themselves up to nothing could not tell the difference right up to the end. I want you to be able to. That is the whole purpose of the next half hour. 3 stops on the way. First, a telephone call in 1948, how the decision even came to land on my desk, because that part matters more than people think. Second, why a man who wrote a book about the margin of safety did the one thing his own book most clearly forbids. And third, what that single company turned out to be worth 20 years later, and why the lesson is not, please hear me on this, simply be bold. If you walk away from tonight thinking the moral is be bold, I will have failed you and I will have done you real harm. Let me start with the call, because I did not go looking for GEICO. GEICO came looking for me. And the reason why is the first thing most people get wrong. In 1948, a small auto insurance company came across my desk. Government Employees Insurance Company, GEICO. Not a household name. Not in those days, nothing like the name it would later become. A modest thing run out of Washington, selling automobile insurance directly to government workers and military officers. And I will be honest with you about my first instinct, because it does me no credit. I did not like insurance companies. For most of my career, I had held them at arm's length, a long-standing distaste for the whole category. They were hard to value from the outside, full of reserves and assumptions and promises about a future no one could see. So the very industry this opportunity lived in was one I had spent years avoiding. And here is how it reached me anyway, which tells you something about the nature of opportunity. One of the founding families that owned GEICO, a family named Rhea, wanted to sell their stake, a large stake. They went, as sellers do, to the big prestigious investment houses first, the famous names. And the famous names turned them down. A small, unglamorous insurer selling policies by mail to government clerks, it was not the sort of thing that excited the grand firms of Wall Street. So the bankers and lawyers handling the sale worked their way down the list, door to door, until they arrived at the door of a partnership called Graham Newman, mine. I want you to notice something there, because we will come back to it at the very end, and it is the quiet key to this entire story. The opportunity of my life arrived only after it had been refused by everyone more fashionable than me. It came in through the side door, rejected, slightly shop-worn, carried by men who had already heard no a dozen times that week. The greatest financial decision I would ever make did not announce itself with trumpets. It shuffled in looking like something nobody else wanted. A man came with it, Lorimer Davidson Davy, everyone called him, who was helping the family find a buyer, and who knew the inside of that business better than almost anyone alive. He sat with me. He walked me through the numbers, through the model, through the strange and beautiful simplicity of what this little company was actually doing. And the more I listened, the more I understood why it was cheap and why cheap was the wrong word for it. Let me explain the business, because you cannot understand my decision without understanding what I was looking at. In those years, nearly all insurance was sold through an agent. A man who knocked on your door, wrote your policy, shook your hand, and took his commission for the trouble. That commission was not free. It came out of the premium, which meant every customer was quietly paying for the middleman, whether he valued him or not. GEICO had a stubborn, almost impertinent idea. Cut the agent out entirely. Sell straight, by mail, to a carefully chosen kind of customer government employees who tended to be steady, sober, responsible people, the sort who do not wrap their cars around a tree on a Saturday night. Fewer accidents, fewer claims. And because the company spent so much less to bring in each new policy, it could charge the customer a little less and still keep more for itself. Lower price for the buyer and higher profit for the seller, out of the same simple act of removing a man who was adding cost without adding much. The numbers Davy showed me were not subtle. The company's costs against its premiums ran at a fraction of what its ordinary competitors spent. It was not a little better. It was structurally better at the bone. So this was a plain, unglamorous business that did one important thing better than everyone around it, and did it quietly year after year without fuss. That is precisely the kind of business I had spent my life teaching people to find, and it was being offered to me at a discount to what it was already worth on its own books, roughly a tenth below its plain book value. Cheap and excellent at the same time. That combination is rarer than you would think, and when a careful man finally sees it, the danger is not that he will be too timid. The danger is the opposite. What happened next was not plain at all. My firm, Graham Newman, bought half the company, 50%, for around $712,000. As part of the arrangement, I became chairman of its board, and Davy, the man who had brought it to me, joined the company itself and would one day run it. And that sum we paid, the $712,000, this is the part that all these years later still makes me uneasy to say out loud, came to roughly a quarter of the entire fund, a quarter. Stop and feel the weight of that against everything I told you at the start. A man who held more than 100 securities at a time precisely because he did not trust any one of them too far. That same man took one private insurer and made it a full quarter of everything he was responsible for. Picture it another way. Picture a man who has spent 30 years lecturing everyone he meets about eating moderately. Small plates, a little of this, a little of that. Never, he says, wagging his finger, let one single dish dominate the entire table. And then one evening, in front of all his students, that same man sits down and heaps a quarter of the whole meal onto one plate and picks up his fork. That was me in 1948. And the man across the table, the rest of the investing world, knew exactly word for word what I had written about portions. There was no hiding it. My own book was the witness against me. Now, let me separate two things very carefully, because if you let them blur together, you will not only misunderstand this story, you will carry the wrong lesson out into your own life and pay for it with your own money. There is the arithmetic and there is the psychology. And I am going to name which is which out loud as I go, because the entire trade of investing, when you strip away the noise, is the discipline of keeping those two apart and never letting one wear the other's clothes. The arithmetic was clean, genuinely clean. We could buy GEICO for less than what the business was plainly, soberly worth on its own books. There was a cushion underneath, the price real assets, conservatively counted, that added up to more than what we were handing over. If I turned out to be wrong about the company's future, and a careful man builds his whole house on the assumption that he might be those assets were still there, beneath my feet, holding me up, I was not paying for a dream of what GEICO might someday become. I was paying less than what GEICO already demonstrably was. That part, the figures could settle, and the figures did settle it. The numbers told me, in plain language, that a margin of safety existed. And numbers, whatever else you say about them, do not get nervous. They do not lie awake at night. They simply are what they are. But the psychology that was an entirely different matter, and no column of figures was ever going to settle it for me, because the arithmetic said buy clearly, and the rule I had built my whole reputation on said do not put a quarter of the fund in one single place, just as clearly two voices, both of them mine. One of them mine on paper, in print, with my name embossed on the cover, the voice, the whole world associated with me, and the other mine in the room that afternoon with the actual decision sitting there in front of me demanding an answer. And I will tell you plainly, I hesitated. I want you to know that because the legend leaves it out. I did not stride in like a man who had it all worked out and was merely collecting his reward. I was uncomfortable, and I stayed uncomfortable for a long while. From almost the very start, the price we paid looked too high against the standards I myself had set down in ink. Think about that contradiction. The price was a discount to book value cheap by any outside measure, and still it troubled me because the size of the position offended a deeper rule than price. I owned a wonderful little company at a bargain, and I could not fully enjoy it because of how much of it I owned. And here is the question that should be nagging at you by now, the one I would be asking if I were sitting where you are. Why would I, of all the men on Wall Street, take that risk? A man does not spend 3 decades preaching caution, building a 100-stock portfolio as a monument to his own humility, and then casually fling a quarter of his fund at one small insurer on a pleasant afternoon. Something had to have prepared me. Something had to have earned me the right in my own mind to do a thing that frightening. Caution like mine is not broken lightly. It is only ever broken by a man who has already paid in full to learn what the other side costs. And I had paid. That is the thing you must understand before any of the rest of this makes sense. I knew better than almost anyone drawing breath at that time exactly what recklessness costs, not as a theory, not as a chapter in a book, but as a number carved into my own accounts and into my own household. 16 years before that GEICO afternoon, recklessness had very nearly finished me. Let me take you back there. It is not a pleasant memory. I have never pretended otherwise, but it is the memory that makes everything after it make sense, and I would be cheating you to skip it. The crash of 1929 and the long grinding years that followed it, that was the great wound of my career, the wound that never fully closed. Now everyone remembers October of 1929, the crowds outside the exchange, the famous headlines, the photographs, but those of us who were actually managing other people's money, we do not remember October of 1929 as the worst of it. We remember what came after, and we remember it differently, because that is where the real destruction was quietly done. The crash itself was loud and brief. The aftermath was slow and patient, and grinding and patient is so very much worse than loud. A loud disaster you can brace against. A patient one wears you down a little more every single month until there is nothing left to wear. Let me walk you through it the way I actually lived it, year by year, because the shape of it, the cruel, instructive shape of it, is the whole point. In 1929 itself, the worst of the headlines did not even wound my fund too badly. The market had climbed so high through the earlier part of that year that the October collapse measured against the whole 12 months looked almost survivable. My fund came through 1,929 down, but standing, bloodied, upright. And I thought, as any reasonable, intelligent man might have thought, as a great many reasonable, intelligent men did think, that the storm had largely blown itself out, that the worst was now behind us. Then came 1,930. And 1,930 is where I made the single greatest mistake of my entire life. In the early months of that year, the market rallied, it rose, it looked for a hopeful season as though the bottom had been found and the recovery had begun. And I believed it. I let myself believe it. I was convinced, and this is the precise mechanism by which careful men destroy themselves, so watch it closely. I was convinced, along with so many other clever people, that the worst was over and the bargains were now simply lying in the street waiting to be picked up. And so I did the very thing I would spend the rest of my life warning the entire world against. I leaned in. I invested aggressively into my own conviction. I used borrowed money to do it leverage, which is nothing more than a tool for making your mistakes larger than yourself. I let a rising market do my thinking for me, which is the oldest and the most expensive era there is, older than Wall Street, old as human hope itself. The market did not recover. It had only paused to take a breath. It turned, and it fell, and then it fell again, all through the rest of 1930. By the end of that year, the losses were severe, and it did not stop there. It never stops where you need it to. The bleeding ran on, relentless, into 1931. And by the time it had finally fully run its course, my fund had lost something close to 70% of its value. 70%. Let that number sit. Years of patient, careful, intelligent work, and most of the capital simply gone, evaporated, as if it had never been real at all. I will tell you a cold comfort now, and I want you to notice, as I say it, how very little comfort it actually contains, because this is a lesson inside the lesson. The broad market lost even more than I did, around 80%, top to bottom. In some of the very worst stretches, I actually lost less than the market around me in 1931, when the averages fell by something near half again. My fund fell by considerably less than that, and the year after, I lost only a few percent, while the market dropped once more. By the standard of the wreckage all around me, I was holding the line better than most men in my profession. I was, relatively speaking, doing well. And here is the lesson inside the lesson, so hear it. That fact bought me nothing, nothing at all. When you have lost 70% of what people you respect personally handed you and trusted you to keep, the man next door losing 80 does not buy back one single hour of your sleep. Relative success inside a catastrophe is still, in your own home, at your own table, a catastrophe. You do not repay the people who trusted you in the currency of we beat the average. You repay them in dollars, actual dollars, and the dollars were gone. The comparison is a comfort you offer other people. It is no comfort at all to the man in the mirror, and it reached past the office into the house, which is the part of the story I rarely tell and will tell you now. The partnership survived those years only with the help of friends, and only by selling off most of what my partners and I personally owned. It came into my home. My own wife went back to work to help us through it, returned to teaching dance to bring money in, while the man she had married, the supposed expert, the future father of value investing, tried to keep the thing from collapsing entirely. That is what recklessness actually costs in the end. Not an abstraction on a chart, your wife's time, your friend's goodwill, the furniture, the pride. I learned the price of the bold bet not from a book. I was the book's author, and the book had not yet saved me. I learned it in my own rooms, from the faces of the people I had let down. So now sit with the irony of it, because this irony is the hinge on which the whole story turns. The man who would 16 years later calmly put a quarter of his fund into one insurance company that is the very same man who had already been brought all the way to his knees by overconfidence, who had already watched his own certainty cost his family their security. You would think any sensible person watching would surely think that such a man had learned once and for all to never, ever again bet big on anything, that he would spend the rest of his days hidden safely in cash and bonds, flinching at every shadow on the wall, never risking a concentrated dollar again as long as he lived. But that is exactly the wrong lesson. And the strange, hard-won truth at the center of tonight is this. It took those very losses, those specific and humiliating losses, to teach me why it was the wrong lesson and to make me, of all people, capable of breaking my own rule correctly the one time it mattered most. Here is the difference. It is the whole story compressed into a single image, so take hold of it and do not let go. There is a man who jumps into the water because he is reckless and has not the faintest idea how deep it is. And there is a second man who jumps into the very same water from the very same rock because he has measured it first and he knows from the shore. Both men jump. They make the same arc, the same splash, the same sound. To every spectator on the beach, they are completely, perfectly identical. But one of them is gambling with his life and one of them is not, and the water knows the difference even when not a single person watching can tell. In 1929 and 1930, I jumped without measuring. I had borrowed. I had hoped. I had let the warmth of a rising market stand in for the cold work of actual analysis. I leapt because everyone around me was leaping, and the water looked perfectly fine from where I happened to be standing. I did not measure. I assumed. In 1948, with GEICO, I jumped again. I broke the very same rule about size, a full quarter of the fund in one single name, but this time I had measured the depth before my feet ever left the rock. The cushion was real, and I had counted it myself by hand, the way I had taught a generation of students to count it. It sat there underneath the purchase price, in the assets, in the plain, unarguable arithmetic of what the company already owned on the day I bought it. It was not floating somewhere out in my hopes about what the business might do next year, or in 5 years, or in 20. That is the entire difference between the two jumps. Not nerve, not courage, not boldness, which is the word the legend wants to use. Measurement, only measurement. So I broke the rule with discipline, if such a strange and contradictory thing is even possible, and I am telling you that it is. Not because I had stopped being afraid. I have already confessed to you that I hesitated, that I was uneasy the whole way in, that the size of it troubled me, even at a bargain price. But because the fear, this second time, was pointed at the right thing, in 1930, my fear had been of missing the recovery fear of being left out, the most expensive fear there is. In 1948, my fear was of overpaying, of losing my footing, and I had done the work in advance to make certain I was not the same emotion entirely. Fear aimed the two times in precisely opposite directions. One version of that fear nearly destroyed me and my family. The other version made my entire career. Same man, same feeling in the chest. Opposite outcomes because of where the fear was aimed and whether the work had been done before the leap or merely hoped for after it. And yet, if I really had measured the depth so carefully, if this was skill and cold judgment and patient analysis and not luck at all, then why did I, near the very end of my life, say out loud, freely, to anyone who bothered to ask, that most of what came out of GEICO was luck? Why would the man who measured the water so carefully turn around decades later and hand the credit to chance? Let me stop here and gather the thread before we go on, because the most important part of all of this is still ahead of us, and I do not want the shape of it to slip away from you in the details. One rule, held faithfully for an entire lifetime. One afternoon, I broke it, and a loss I had already paid for in full, 16 years earlier, paid for in capital and in pride, and in my own wife's returned labor, was the thing, the only thing, that had taught me how to break that rule without destroying everything a second time. So here is the question this whole story has been quietly circling from the first sentence, the one I want you turning over and over in your mind while you listen to the rest. If the best investment of my life came from breaking my own most famous rule, then either the rule itself was wrong or I simply got lucky. There is no third option that conveniently lets me keep my reputation spotless. One of those two uncomfortable things must be true. And then the harder question, the one that actually has your name on it, sitting wherever you happen to be sitting and listening to a dead man talk about a deal from 1948. When your turn comes, and it will come, it comes to everyone who stays in this game long enough, how exactly will you tell those two apart? How will you know whether you are the man who measured the water or only the man who got lucky and lived to brag? Let me give you the number first, and then let me tell you very carefully what the number does not say, because the number is seductive, and seductive numbers are precisely how careful people get themselves ruined. The number is the trap, not the lesson. That stake in GEICO the one that cost around $712,000 in the spring of 1948, was worth close to $400 million some 20-odd years later. More than 500 times what we paid for it. I have done those sums many times over the years, almost in disbelief, the way you keep pressing on a bruise to check that it is still really there. Let me give it to you from the small end, too, because the small end is where it becomes real for an ordinary person. An investor who had owned just 100 shares of my fund in 1948, a holding worth around $11,000 at the time, who simply held on, who did nothing clever, who merely kept the GEICO shares we were forced to hand out and did not sell them, that person would have had something on the order of $1.5 million by 1972, from 11,000 to $1.5 million for the supreme effort of sitting still, and the profit from that one single decision, that one afternoon's judgment about a company nobody fashionable had wanted, came to more than everything else my partners and I earned across 20 years of work. 20 years of investigation, of endless pondering, of a 100-name portfolio and countless small, careful, intelligent decisions in the field we knew better than almost anyone. All of it, the entire patient lifetime of disciplined effort, outweighed by a single yes to a deal that had come in through the side door after better men turned it away. Now, you are waiting, I know, for me to explain to you how brilliant all of that made me. You have heard the number 500 times 400 million, and the number is on its knees begging you to crown me a genius. I will not let you do it, because I do not believe it is true, and I have said so plainly in public to anyone who would listen for the rest of my days. After we made that GEICO investment, I once remarked, from then on we seemed to be very brilliant people. Seemed that one small word is carrying an enormous weight, and I placed it there on purpose, and I need you to hear it land. The world looked at the result, only ever at the result, and decided I was a genius. I looked at the exact same result and saw with perfect and slightly uncomfortable clarity how much of it I had never controlled at all. The outcome flattered me far, far beyond what the decision itself had actually deserved. The decision was sound. The magnitude of the reward was a gift, and I knew the difference, even as everyone around me insisted on forgetting it. Let me tell you what I have come to believe about luck. After a long life spent watching it arrive at some men's doors and walk past others for no reason anyone could ever name. Behind the lucky break, there is almost always a long, invisible background of preparation, of discipline built up patiently across years when absolutely no one was watching and there was no reward in sight. The opportunity knocked at my particular door and not at the doors of the grander firms who saw the same deal and waved it away, because I had spent 30 years quietly making myself into the specific kind of man whose door that opportunity would recognize when it came shuffling down the street. I had built the means to act when it finally arrived. I had earned, through 1,000 smaller cases, some real judgment about what I was actually looking at. And I had the courage that one time to act on it despite my own considerable discomfort. Luck still had to walk in through the door on its own 2 feet. I could not summon it. No one can. But here is the cruel and crucial thing, the thing that separates the lesson from the legend. Luck does not wander in off the street to just anyone. It comes to the prepared, and then, having come, it quietly lets the prepared man take all the credit for its arrival, which is precisely how so many genuinely prepared men talk themselves into believing they are invincible and walk back out to the rock and jump again and drown. So let me finally answer the question I have been holding over your head this whole time. Was the rule wrong, or was I merely lucky? Both, and neither. And this right here is the part I most want you to carry out of this room tonight. If you carry nothing else away from a dead man's voice, I broke one rule, I did not break the other, and absolutely everything depends on knowing which was which. The rule I broke was the rule about size, about how much to place in one single basket. That one I violated openly, knowingly, with my eyes fully open and my own book glaring at me from the shelf, and it made me a fortune. But the rule underneath that one, the deeper rule, the foundational one, the rule that actually keeps a man alive across a long and dangerous career, the margin of safety. That rule I did not touch. I would not touch it. I bought GEICO for less than it was plainly, provably, arithmetically worth. The cushion was there beneath me from the very first day I owned a single share, and it never once depended on the future being kind. So when fortune did, in the end, turn out to be extraordinarily generous, 500 times generous, I had not bet the fund on fortune being generous. I had bet on the cushion. And I had let the fortune be a gift laid on top of a floor that was already solid, whether the gift ever came or not. Let me put it to you as plainly as I am able, because if there is one sentence I would carve into the inside of every investor's eyelid so that he saw it every time he closed his eyes, it is this one. The thing that saved me was not the gamble. It was the margin of safety sitting underneath the gamble. Take that cushion away, keep the exact same bold move, a quarter of the fund in one private insurer, but strip out the discount to book value, strip out the floor, and the very same decision is nothing more than recklessness that happened this time to be rewarded, identical on the outside, opposite at the core. I have personally known men who made that exact bet, the bold, concentrated, all-in bet without the cushion underneath it. You have never once heard their names. And there is a reason you have never heard their names, and we are about to arrive at it because it is the last and most important thing I have to give you. But first, one small, almost comic proof that even the great good luck of my life arrived tangled up with trouble, because fortune, I promise you, never hands you a clean envelope. That purchase, 50% of one company held inside an investment fund, accidentally ran straight into a regulation. It turned out, to everyone's surprise, that an investment fund of our kind was simply not permitted to own an insurance company outright in that manner. And so we were ordered the very next year to take that holding and distribute a great part of it out directly to our own shareholders. GEICO became a publicly traded company in no small part because we had, in a strange sense, bought too much of it too correctly. The single greatest windfall of my professional life showed up on the doorstep with a legal headache already stapled to the front of it. Even the masterstroke came with a tax of aggravation attached. That is simply how it comes. It never arrives clean. Now I want to say something about why you have heard this story at all, why it survived, why it traveled all these years and finally reached you tonight in my voice and not someone else's. You have heard it for one reason only, because it ended well. That is the entire reason, and it is a far more disturbing reason than it first appears. If GEICO had failed, and make no mistake whatsoever, a small insurance company in 1948 could very easily have failed, as thousands of small companies in every line of business quietly failed in those years and were forgotten if GEICO had failed. You would never once have heard my name spoken anywhere near it. I would have been a footnote in some other luckier man's book. A respected fund manager who late in an otherwise careful career made one foolish, oversized, out-of-character bet on an insurer nobody wanted, lost a quarter of his fund in a single stroke, and quietly, permanently disappeared from every conversation that mattered. No intelligent investor with a triumphant postscript, no father of value investing, a cautionary tale, if I was remembered at all. And here is the thing that should chill you slightly, because it chilled me. The men who made the exact same kind of bold, concentrated, all-in bet that I made and lost, and there were many of them. There are always, in every generation, a great many of them. Those men do not write the books. Nobody interviews them in their old age. Their portraits are not hung on the walls of business schools. Their letters are not studied. They are not on the shelf next to me at the bookshop offering you their hard-won wisdom about boldness. They are simply gone, erased, silent. And so you sitting there listening, learning, you only ever get to hear from the one voice in 100 that happened to survive the jump. And survival, I must warn you, is the most dishonest teacher that has ever lived. It leans down close to your ear, warm and convincing, and it whispers that the bold are always, in the end, rewarded. They are not. You are simply never in the room with the ones who were punished for the identical act. The room is full of them. It is more crowded than you can imagine. You just cannot see a single face in it because the dead do not give interviews and the ruined do not publish. You are listening to the survivor and mistaking him for the rule. So let me bring this all the way home now, away from old numbers and dead decades and a deal struck before you were born, and set it down gently, directly, in front of you. Because the market, you understand, was never actually the dangerous thing in this story. You are. You always were. The market is only weather. You are the one who decides whether to go out in it and how far and whether you measured the water or merely hoped. The real risk is not that you will one day break a rule. You will. I promise you that you will if you stay in this long enough to matter. A genuine opportunity may come to you only a small handful of times across an entire lifetime, and on the rare occasion when one truly does, a single, well-made decision may indeed count for more than years upon years of patient, ordinary, honorable work. I am the living proof of exactly that, standing here and telling you so with my own mouth, so I'm not going to insult your intelligence by instructing you to never, ever act boldly. That would be a lie, and my own life would be the first and loudest witness to expose it. What I will tell you instead is this, and I need you to hear the precise and careful shape of it, because the shape is the whole gift. The danger was never in the breaking. The danger is in not knowing which rule you are breaking, and far more importantly, which rule you must never, under any circumstances, in any weather, for any temptation, allow yourself to let go of. Break the rule about size if the moment has genuinely, provably earned it. But only if you still have all four of these things gripped firmly in your hands at the very same moment. The means to act, the judgment to actually see what is in front of you, the courage to move when seeing is not enough, and a real, counted, solid floor beneath your feet that does not depend on the future being kind to you. Keep the margin of safety. Always, in every season, in every market, in every story, you tell yourself about why this time is the exception. That is the one rule that never, ever goes onto the table. The rule about size is a guideline-wise, protective, breakable once or twice in a life by a prepared man. But the margin of safety is the floor you are standing on while you reach across to bend the guideline. Bend the guideline if you must. Never, for one instant, step off the floor. And the most important thing of all, the very last thing, the thing I lower my voice to say, because it has cost so many genuinely good and genuinely capable men every single thing they had. When it works, and now and then, for the prepared, it truly will work. Do not call your luck a skill. Do not do it. Be honest with yourself, in private, in the quiet, where there is no audience and no one is keeping score, about how very much of the result you did not actually earn. The man who can look at his own $400 million outcome and say out loud and without flinching, "We only seemed brilliant," that man keeps his head. That man lives to see the next cycle and the one after it. But the man who believes his own legend does the precise opposite. He takes the credit that belonged to chance, and he files it away as proof of his own genius, and the next time the rock appears, he walks straight back out onto it, oversized, certain, smiling, with no cushion at all beneath him, because last time, you see, the water was kind. And the market, patient as it has always been, patient as it was in 1930, collects from him exactly to the penny what it is owed. I have watched it happen. I have watched it happen to better, quicker, more naturally gifted men than I ever was. And I will tell you something plainly, because there is no longer any reason for me to protect my own vanity. I came close more than once to being that example myself. Twice, if you are honestly counting. The first time, in 1930, it nearly took everything. The second time, in 1948, I had simply learned enough and suffered enough to measure the water before I jumped. So here is the only thing I would truly ask you to write down tonight, if you write down nothing else from an old man's long story. I broke the most expensive rule of my life exactly once. And I was lucky enough and just barely, only just barely, disciplined enough to not break the one rule that had kept me alive through everything that came before it. The rest of it, I am afraid, was never quite as brilliant as it looked.